Good morning, good morning. How you guys doing today? Welcome. Monday morning, April 8th, 2024. Hope you guys had a good weekend. And lots of alerts coming in for me here. Just taking a look here at my Yahoo Finance page. You guys use Yahoo Finance? I find it quite convenient for looking up tickers and getting the news. And I usually like to start the week off by, taking a look at what has been taking place in the world over the weekend, see what the headlines are, see what the media is trying to get people to pay attention to at the beginning of the week. And was looking at the Wall Street Journal this morning, and I saw an article about interest rates, and maybe there's not going to be as many interest rate cuts this year. I think that was the first one. More traders are betting the Fed may cut the benchmark federal funds rate just once or twice this year, fewer than officials' last median forecast. And a handful are starting to wager that the central bank will leave rates where they are. So I guess they know how traders think and feel. Don't know. But I guess they know something that we don't know, because as the years have unfolded and I've been following Wall Street Journal, it's just incredible how they are always so in tune with what investors and traders are thinking. I don't know who they're polling, but it's always quite incredible to me that they always have this this tap into the mind of retail traders. I don't put much weight in what they write when they tell us what retail traders are thinking about. I usually look at it as they're trying to put this idea in people's head. Okay, they're trying to put the idea in people's heads that we should be thinking something. So, for instance, I read this article and I'm thinking, you're trying to put into my head that they may not be cutting the rates. And, when you look at TLT, for instance, here's the 20-year Treasury bond. And you can see over the last several days, it's been trekking to the downside. And it's very likely because of articles like this. When you put fear into people that rates are likely not going to be cut, then bonds drop. And this is that an example of that right now. So what's also interesting, excuse me, what's also interesting to me is if we bring up the CFTC report data for bonds, you can see that there's been a shift taking place here. Okay. Let me just bring up something here. Bring up a nice clean version to look at, and it's right there. There you go. So here's the data that I'm talking about. So we've been tracking what the banks have been doing with bonds for quite some time. And when we look at it, we could see that back in last year, early beginning of this year, we can see that they're quite aggressive with their short positions, okay? And you'd have to go back to see exactly how they accumulated this position. But the bottom line is, if you take a look at short positions, you can see that there has been a steady aggressiveness in their positions. And the reason being is because we just finished dropping quite dramatically all of 2022, 2023, right down here to the bottom. So there's been a dramatic drop, and the reason for that drop is, well, interest rates were increasing like crazy, right? That's enough to cause bonds to drop. And so the institutions were short bonds. But it gets to a point where, well, what are you going to do, right? You're going to keep on shorting? Well, you can't keep on shorting. You know, back in January 9, they reached positions 334,000, right? Their ultimate size, their maxed out size was 359,000. So they were reaching maxed out positions. And what typically happens when they reach the maxed out positions is they start taking profit on those positions, right? But how are you going to effectively take profit on a short position unless you have somebody to take those positions from you, right? And so this is when you have characters such as Bill Ackman, who comes in and he announces to the world that he's going to short bonds, right? And that gets everybody excited. And that gets everybody into the market as well. And so I pointed that out when he came out and advertised that he was going to open up his position. And I said, listen, there's a reason why these people do this, okay? I mean, do you think a top investor wants to really advertise his positions unless it's going to suit him or suit others that he is loyal to? Not really. So you have to really keep that into consideration. So when I'm looking at bonds here, a few things stick out really. And one is that, you know, they recently reached maximum short positions. And not just that, but take a look at the coloration here. Okay. When you look at long and short percentages, back in September, October, and November, you could see that they were bearish, okay, clearly by the coloration of the cells. And then what took place there after that, leading into February 2024? Look at the positions. Look at the coloration. You see more blue, okay? That's because they were neutral. And if you look at the coloration of the cells here, you can see that they're slightly starting to turn green. So there's a momentum shift, a momentum of bearishness into neutral and slowly into bullishness taking place. And at the same time, articles are coming out on the Wall Street Journal that are preparing retail traders to have this thought of, you know, be careful, because some other traders, investors who are more intelligent than you and who are more aware than you are starting to think that they may not even cut rates. Okay? So you see how these things are related? So I'm watching this. I'm watching bonds and watching the momentum shifting. And I think it's very interesting, to say the least. All right. And look, this morning, bonds are down. They closed at 91.39, and this morning they're down to 90.63. I should say that price is inside an institutional buying area. So this is the perfect time for that transfer of short positions to be taking place. So that's one thing that sticks out. Okay, and you know, Jamie Dimon flags worries over stickier inflation and higher rates. Of course, playing a role in that as well. So what would that mean for the dollar? It's an interesting question. If rates increase, strong dollar, right? If rates decrease, weak dollar. Well, you know, when I look at the U.S. dollar, one thing that really sticks out is the data, and it's not in line with what we're seeing with the other dollar pairs. Okay, and I pointed this out in the latest CFTC video that I did, but that's something that really sticks out for me. I'm seeing aggressiveness with shorts for the dollar. But when you look at U.S. CAD, you see aggressiveness to the long side. When you look at US Swiss, you see aggressiveness to the long side. When you look at US dollar Japanese yen, you see aggressiveness to the long side. So there's this consistent, constant theme of aggressiveness with long positions on dollar pairs. And that's consistent with what we are seeing with respect to evidence of downside pressure on pairs such as Euro, US dollar, Pound, US dollar, Aussie, and Kiwi. All right, but let's go over to S&P 500, because this isn't one that is covered in the CFTC analysis videos that I've been doing. But as I did mention at the beginning of that video, when you look at the snapshot of the positions, one thing that should really stick out to you is the S&P. Okay, this one here. Zoop. Why is that? Well, because if you look at the change, okay, the change is positive 186,000. That's huge. Okay, that is a huge number. 186,000 positive, right? And you, of course, you can see bonds here, right? Negative. Okay, putting negative pressure on price, causing it to move down. Then you put out the headlines. Retail traders look at the news, they look at the charts, they see the pressure to the downside, and that's the bait, right? That's the bait that's put out there, right? Many times when you look at CFTC data, what you'll see is big movements on the short and the long side. And this is to create chart patterns that retail traders will look at and be triggered. So, S&P 500, big increase in to the bullish side. So when we go over to the data, what do we see? Well, what I see is a big reduction in short positions here. You know, for the last several weeks, we've had short positions be somewhat aggressive. Okay. Their short positions have been somewhat aggressive as price has been increasing. But this last week's data shows us a massive shift of about 100,000 positions, closing off short positions. Now, if we go over to the S&P data, take a look at the chart. Let me bring it up here. Here we go. This data represents this up here. Okay? Because remember, when you look at the data, April 2nd is the date, okay? And if you go to this candle, the red one here, it begins April 1st, meaning there's only 1 day of trading incorporated in that data that is represented in this candle. So I tend to not even bother paying attention to that candle. It's the prior candle. And so what did we see? A retracement in price down to where? An institutional buying zone. So when we look at the data and we see that they are taking profits on short positions or reducing their overall short exposure, it happened at a time where price was just about to drop down into an institutional buying zone. So as far as I can see, pressures to the upside on price. Demand is in play. Trends are to the upside. Okay. This is extremely bullish chart. You know, but a lot of people like to just focus on the smaller time frames and view these big drops and think that it's the beginning of a bear market. No, no, no. This is not the beginning of a bear market. Not even close to being the beginning of a bear market. These are just retracements to areas of demand. And they present opportunity for those that are looking to buy the market. So, so for me, this is still a very bullish chart. Okay. And if we look at the Nasdaq as well, it's bullish. It's moving to the upside. Demand zones are lower. In fact, this one hasn't even retraced to any significant demand yet. Okay, but still upward momentum. Even the Dow Jones has demand in play. If you look at the weekly chart, this is demand that price came into. So bullish momentum is expected. Could they come in with selling right now? Yeah, of course they could. But, you know, we're not talking about what could happen. We're talking about what is happening. Okay? What is happening is the banks created a buying area here, and they dropped price into this buying area. That is what is happening. So based on what is happening, what is likely to happen is bullish pressure. Unless they come in, like I said, and drop price. Okay. Before I let you go, I want to mention something. Last week we did a video on the Euro US dollar. We were watching NFP, watching the data, and speculating on what was going to take place with the data. And I said the scenario is likely, from my perspective, from what I'm seeing and from following the storyline. You know, when we're following the storyline, what's the point of that? The point is to determine what is taking place in the market. If you don't know what's taking place in the market, how can you trade it? If you don't know what the banks are in the middle of doing, why would you want to open up a position, right? Since you know that the banks and institutions are the ones that move the market, don't you think it's in your favor to know what it is that they're up to? It is. So what I always like to do is figure out what they're up to, and based on what they are up to, try to determine what the data will probably be to help facilitate what they need to facilitate. And so we were looking at NFP, and I had determined, you know what, I wouldn't be surprised if it came out to be negative for the dollar. Why is that? Because retail traders were so massively short, okay? And the only thing that they could do now is offload those shorts for longs, right? So how would you get them to offload shorts for longs? Well, one method that I've seen in the past is they come out and they make the euro look bullish. How would they do that? Well, bearish. But what ended up taking place was, because supply was already in play, because the institutional supply was already in play. And what do I mean by that? Well, because when we examine this 4-hour chart, there's supply and demand zones being created, okay? We had demand being created here, and then that demand got removed, and then we saw supply being created by the institutions. Supply. This is right before the data came out. Supply zones were being created, and they came into play. So what took place? Positive data for the US dollar, right? Positive data for the US dollar, which was negative for the euro, and price immediately dropped. But basically the effect was the same, okay? That's the point that I'm trying to make. The effect was the same. Look at what their positions were. 93%. Look at what it was just recently. 77%. And if I look at what they are now, let's take a look. 67%. 67%. So at the end of the day, they were able to get them to offload those shorts. Now it's 64%. I just refreshed my screen. 64%, guys. That's the point. Okay? It's the point I was making. 64%. 64%, they still managed. And how do you think they managed that? Well, listen, I've practiced magic all my life, okay? Those that have been following me and are members and students with us at the school know that since I was a young kid, I've always been fascinated with magic and illusions and magicians and all that stuff. And I always wanted to learn the secrets of these magicians. And so I started to learn reading books and going to magic conventions, and I've studied a lot about magic. And one thing that I learned about magic is that a magician, a really good magician, will learn several methods to perform the same magic trick. And the reason being is because you will perform, and this has happened to me several times, because I end up doing shows and private parties and a lot of things. But you'll always get somebody in the crowd who's a thinker. You know, most people, you show them a trick, they're like, wow, that's beautiful. How did you do that? And they drop it. And they love to be amazed, and they leave it alone. But there's always some people that are big thinkers, and they need to solve the puzzle. And you'll do a coin vanish, and they'll say, oh, wow, okay, can you do that again? Because they're going to make sure that they're going to be looking more intently, more suspiciously the second time around. And the foolish thing is to do the trick using the exact same method, because what they weren't watching last time, they're going to watch this time. And it may be the thing that you don't want them to watch. Because if they watch and they see, they're going to see how the method's done, and they're going to clue in. So what you need to do is you need to change the method so that the effect still looks the same, but regardless of what they're watching for, they will miss it, because you're achieving the same end effect using a different methodology. And I would do that many times. Those people would say, oh, can you do that again? I would make the coin vanish in a secondary method. And they'd say, do it again. And I'd use a third method. By the time I did it 3 times, they had absolutely zero clue what was happening. And the market makers are the same way. So it's like, I know the end effect that the magician is going to create. What methodology is he going to use? Most of the times I can nail methodology because the telltale signs are there. I can see the way that the magician is moving his hands, how he's shuffling the cards, how he's manipulating the coin. I could usually see what methodology he's going to use, but sometimes I make a prediction and it's not 100% right. The bottom line is, it's the end result. The end result is what's important. This is what I'm trying to convey. And what took place here, price dropped dramatically. Now let me ask you a question. I want you to think about this. Price dropped. They were holding shorts. Retail traders were happy. I'm sure they were partying, jumping up, fist bumping, all that stuff. But what happened when price immediately started to rally up? What did they start thinking? Uh-oh. This news was negative. This should have just continued to drop, but it's not dropping. What's going on? Uh-oh. As it got closer and closer, what do you think they're more inclined to do now? They had a position that was in profit. It dropped. Now they're losing that profit because it's coming up against. What are they more inclined to do? I don't know. Maybe offload those shorts. So the end effect is the same. The offloading of short positions to the banks. Right? Same thing. Only thing is they used a different methodology. So I wanted to point that out to you guys because I thought that was extremely important to point out. Yeah, that's it. That's your Monday morning at 8:24. Hope you enjoy it. There's going to be an eclipse today. Everybody's talking about it. I'm going to be outside. I'm going to be watching. I got to see it for myself. What is going up? What's happening in those skies? The media's really pumping us up and explaining to us what's going to happen. I like to see things with my own eyes. I don't like to trust what anybody tells me. I like to see it with my own eyes. Hope you guys will spend some time doing that too. And that's it. Hope you enjoyed today's session. Please hit the like if you can. Subscribe if you're new to us. And make sure to follow us every morning at 8 a.m. with our live shows. All right, guys, that's it. Enjoy the rest of your day. You take care and talk to you soon.